Assalamualaikum and hello everyone. My name is Nurulana binti Adnan, student of BA 242 4B from UiTM Kedah. So today I would like to present about the difference between the Islamic finance and the conventional finance. Okay, in this video there are three parts, and the first part is the value proposition, second is the structure and the operational mechanism, and the last part is the instruments offered by the different institution and the market. So now let's get started. The comparison between Islamic finance and conventional. Basically, Islamic finance must be conducted for halal activities only, whereas conventional finance cover wider spectrum. Conventional finance has biasness toward loans and the lender-borrower paradigm, whereas Islamic finance promote trading, leasing, and partnership structure. Interest mechanism, which is key in conventional finance, must be avoided in Islamic finance, and Islamic finance shall be governed by both modern and law Sharia principle as interpreted by the Sharia Supervisory Board. The first part is value proposition. In Islamic, it provides free from riba, gharar, and maisir that prohibited by Sharia. Riba refers to the surplus of income which lender receive from the borrower over or above the principal amount, while gharar is risk, fraud, uncertainty, or hazard that may be lead to destruction loss. Maisir refer to the easy acquisition of wealth by chances whether or not it deprives the other's right. Justice and fairness is that it based on the profit sharing principle, whereby the risk is shared by the bank and the customer. This system of financial intermediation will contribute to a more equitable distribution of income and wealth. While for the conventional, it consists of riba, gharar, and maisir. The investment consists of profit that will plus with the interest. The risk did not be shared, but it will be transferred to the client. There are also unequitable distribution of income and wealth. Moving on to the second part, the structure and operational mechanism. The basic difference between Islamic banking and conventional banking is the structure of how the bank is set up. For a conventional banking, the purpose of setup is to collect deposit and to give loans. This is the shareholders' understanding of what it should be. Very distinct function, for example, collect deposit and give loans. And the arrangement is managed by a treasury function which try to balance the returns of shareholders' fund. Under the conventional banking, the modus operandi is first shareholder will give the capital, and then a bank will receive customer deposit and invest it. The last interest received will be distributed, and from the opposite, the customer will request for the loans, and bank borrows interbank funds and lend the funds at an interest rate, and the customer will pay interest plus with the principal. But what is Islamic structure then? In essence, how an Islamic bank is supposed to be set up is based on the theory of sources and application of funds. There should be a single flow between the deposit and the financing or investment use of funds. This means there is no distinct function. It is a single function where customer deposit or investment pool is used to fund financing portfolio or deploy into investment instrument from which returns are derived and recognized. Once the returns are determined, these returns are shared between the bank and the customer. This profit-loss sharing structure demands a different way of managing the bank, although not all Islamic banks are able to successfully pull this off 100%, especially when the Islamic banks are still under the parentage of a conventional bank. There is a linkage between sources and application of fund for treasury, manage liquidity end-to-end, invest in compliant instrument, and manage cost of fund. Next is operation, the detail of work stream, commodity test, and sequencing and akad completion. Next, legal should be contractual relationship, akad and transactional document, Islamic term and conditional. And the last is Sharia review and audit, execution of document, completion of akad, Sharia non-compliance event. Moving on to the last part, that is instruments offered by the different institutions and market in Islamic financial system. First, instruments for mobilizing fund. This group is made up of instruments used by bank and other financial intermediaries in mobilizing or soliciting deposit from the economic surplus unit of an economy. The resources mobilization is achieved through the deposits money bank instruments like the saving account, current account, investment account, and sukuk, that is Islamic bond. The saving and current account under the conventional and Islamic finance are similar in terms of resources withdrawal and deposit terms and conditions. However, for Islamic finance, there is no interest on any amount saved and there is no predetermined returns expected on the deposit. With regards to saving account, only profit sharing is permissible under Islamic finance, whereas interest is paid to depositor under conventional finance. Investment account under the Islamic finance is a replica of the fixed deposit account under the conventional finance. Money is such account meant to generate returns in form of profit or loss, which depends on the money is used for. Therefore, the investment outlets and associated risks determine the extent of returns expected. Under the conventional finance, a fixed interest is fixed on the deposit irrespective of the returns it intends to fetch. The investment account under the Islamic finance has a variation of investment account with or without authorization. In the latter arrangement, the depositor specifies where his deposit should be invested, while in the former, the bank is at liberty to invest in any business deemed profitable by the bank. Sukuk. The issuer of a sukuk sells it to investor and issued certificates and later rent it for a fee. Issuer also undertakes to buy back the certificate in the future at the par value of the instrument. The sukuk that confers partial stake in debt is called sukuk murabaha. Stake in asset is called sukuk al-ijarah, and in normal business is called sukuk al-musyarakah. The last in investment is called sukuk al-istismar. After that, instrument for utilizing fund. In order to effectively utilize the fund generated by instrument of resource mobilization, 4 instruments of utilization under Islamic finance are musyarakah, equity participation, mudarabah, partnership, murabaha, markup, and ijarah, leasing. First, musyarakah or equity participation is also another utilization instrument wherein both the bank and client contribute to the working capital, managerial capabilities, regular assets, and technical experience needed to run a business. At the end, profit and loss are shared according to the negotiated term. Under mudarabah, The bank and the entrepreneur go into voluntary business association, which allows the bank to contribute capital while the client contributes his entrepreneurial skill. If profit is made, the parties share the profit, and where the case of loss exists, only the bank suffer it. Arrangement could also be made to gradually reducing the capital as the business progress to permit for payment of return based on unpaid capital balance. Third is murabaha, is an instrument which allows banks to purchase asset, machinery, or domestic appliance. The customer agrees to take up asset and pays back at the mutually agreed markup on the cost acquired by the bank. Last is ijara. Is also a form of asset financing. An asset owned by a client could be sold and leased back to the seller. Here the seller gets proceeds on sale and have the right to continue the use of such asset at a rental fee, not interest predetermined. So that's all from me. Thank you for watching.